Hey, Best Ever listeners, did you know that this year marks the 10th anniversary of Best Ever Conference? This year's conference is gearing up to be better than ever. I'll be there teaching a fund of funds and capital raising masterclass on the first day. Me, of course, being Richard McGurr, host of Unlimited Capital. And of course, you can come meet me, come talk to me, and all the other Best Ever podcast hosts as well. Seats are limited. Go grab your tickets now at www.besteverconference.com. I will see you all in Salt Lake City. Grab your ticket now at besteverconference.com and use the discount code podcast10, all caps at checkout for 10% off. And you may be listening and wondering why, for the second Tuesday in a row, am I hearing Richard McGurr, the guy who has the Monday slot, on a Tuesday? Well, I'll tell you why. So we're doing another special episode today, which I call Capital Clinic. And that's where I work with people that are just getting started in capital raising. Obviously, people with some track record and know what they're doing, but we discuss what's working, what's not, and help correct and build a stronger foundation and a better growth strategy so that they can raise more capital now and more capital in the future. So hope you all enjoy this episode. Hey, Eric, welcome to Capital Clinic on Best Ever CRE. How you doing today?
Hey, good, Richard. How are you? Thank you.
I'm doing fabulous. So as everybody knows, I'm getting 2 shows this week. So you heard me yesterday on Unlimited Capital and you're catching me today on Capital Clinic. So what Capital Clinic is I help people that are current capital raisers or real estate operators. We dive deep into their business and then we see what's working, what's not, and strategize on growth initiatives. So why don't we start off with you telling me a bit about how you got into this, where you are now, and what you do.
Oh, for sure. Right now, I am solely a capital raiser. So right now, I place private money with operators throughout the country. And really, my story is kind of one of pivots. So I was a finance major in college, and then I took a job in the Cincinnati Fire Department where I spent 17 years and retired as a fire lieutenant. And from there, I went and actually I started my real estate career as a single family rental, basically as a side hustle. And then I grew into renovating duplexes and things like that. And finally, I niched down and, I learned about commercial real estate and I just read and now I'm solely raising capital. And the reason I do that is because I'm looking around and I'm really networked with a lot of great operators. And I actually had a 40 unit under contract, a couple years ago, and I was raising money for that. And I look around and I said, these guys are like great operators. They're finding better deals than me. Why wouldn't I take investor money and place it with the better deal? And so that's kind of how I niched down, actually.
So I think that that's great. I would also consider myself on the same end of that operator to capital raiser spectrum as you. Definitely we put a ton of effort into curating the best deals. Of course, it's an important part of that. I'll never skip that part of the story. But yeah, I would consider myself primarily a capital raiser as well. So what form do you do capital raising? Co-GP or fund of funds, or tell me about that.
I generally use a fund of funds model. And yeah, and I would definitely be, there are situations where I'd be open to a co-GP with the right operators and more so to work with the operators and just continue learning. I definitely lean into the learning aspect, whenever I can. And there's always something new to uncover, when you're raising capital or looking at deals and navigating problems and all that. And obviously a lot to learn about marketing as well. So,
Yeah. So I definitely think it's good that you're primarily raising through the fund of funds model. Obviously, this show doesn't give legal advice, but from everything that I've heard from my own attorneys and other attorneys I've interviewed here, in the capital raiser role, the fund of funds model is much safer. And another thing that I believe is also important is that as a fund of funds operator, you get to maintain control of your brand and your email list, which
yeah,
is
absolutely.
which is really important as well. So speaking of email lists and stuff like that, who do you primarily, one, how long have you been doing this? And number 2, how much have you raised?
I've been doing it solely capital raising for about 18 months right now. And I have raised, I think I've raised $100,000 right now, and I had done one deal, and it was a really good one. It was back in February. So February was my first deal, and yeah, so that's kind of where I'm at.
Okay, fabulous. So tell me about that raise and what you did to raise the money.
So what I did was I reached out to friends and family, and that was basically my entire list. So when I had investors, it was all people with pre-existing relationships. And I was really happy to get that deal because I had been waiting a long time for the right deal to raise money for. So when I went and scoured my list, it turns out a lot of people were definitely turned off and a little skittish about investing in multifamily right now. So just since then I have started a little more outreach and things like that, which we can get into a little bit if you want.
Yeah, tell me what kind of outreach you're doing.
Yeah, so right now I'm focused on reaching out and basically reaching business owners and entrepreneurs on LinkedIn. And the
Okay.
way I do that is I just kind of I look at people like that could use an alternate form of income and additional cash flow and would really benefit from being a passive investor. And I know entrepreneurs and business owners, um, you know, we spend a lot of time and money investing on ourselves and our business. And for me, I had done that, and my 401k was definitely not going to get me where I wanted to be. So I think a lot of people like me can benefit from that. So when I send a request, I just kind of start a conversation and see where it leads, and let basically uh, people get comfortable with me, but really develop a more organic relationship, and just kind of say, hey, at a certain point is like, is there anything I can help you with regarding commercial real estate? Or if you're interested in investing, I can send you a sample deal or something like that.
So right before we got onto this call, I checked your LinkedIn because you mentioned in the show onboarding forum that LinkedIn was your primary lead generation source.
Mhm.
I'm going to tell you something surprising, and maybe I missed it. I had no idea that you directly own rentals, which I've done a lot of research on capital raising, especially as a fund of funds manager. And the direct real estate experience is one of the most important parts, because when I look through your post, you were definitely giving a lot of information on like red flags and how to look at deals, but you did not explain at all how you know this stuff. And I think that the way that it works with people passively investing in real estate is that most of their interest in real estate in general usually starts in a place of, I'm going to directly own rentals. And that I did see a
Mhm.
piece of content that you did, which said like direct ownership of rentals versus syndications, and that one is, a better option is the way you put it, like, especially if you want to be completely passive, which is absolutely true. But something that you never talked about was how you went through the journey of getting here and why you're an expert and why should anyone listen to me, you know? Because at least I didn't see any posts about didn't realize my 401k. I realized my 401k wasn't going to get there. I've been like, how long have you been doing rentals? How long ago did you start doing that?
Ooh, I think I bought my first single family rental in 2014.
Yeah, that's an incredible
And
story.
yeah, and like I said, I bought it as a side hustle. And honestly, I bought this thing because it seemed like a good idea. And the guys at the firehouse table said, "Hey, I do this." And I said, "Hey, that's a pretty good idea." And it made sense as far as like the back of napkin numbers. And I bought, and it was at student housing at University of Cincinnati, because the vacancies were predictable, and I like that. And so I went for it, and I bought it off market and all that. And I got the keys, and I didn't really I didn't know how to be a landlord. So all of
Uh-huh.
a sudden I got the keys, and I go, ooh, I better figure out how to be a landlord. And then I kind of grew into the renovating duplexes and all that. So yeah,
Well,
so there's definitely more to this story.
Well, and it also sounds like you had a lot of success. And I think the important part is that, in my opinion, the core of all good marketing is some sort of transformation that occurs. And I mean, like, whether it's you yourself, well, it starts with you yourself and you telling your story and how, step one, realized my 401k wasn't going to get there. Step two, bought my first deal, even though I didn't really know what I was doing. Then got into rehabbing and like much more sophisticated strategies. And then nowadays, I'm just kind of riffing at this point and guessing, a combination of interest rates and also you wanting to value your time more. You've now decided that passive deals through commercial real estate is the best option. Is that an accurate? Yeah. Yeah. So that is what you should be talking about on your LinkedIn posts, like 80% of the time.
Okay. Yeah.
Especially because telling stories and your background and how you got into something, that's like the actually interesting content.
Yeah.
And sorry, that kind of implies that the other stuff isn't interesting, but it's also kind of true. Telling personal stories of like discovery and struggles, or like, hey, definitely talk about bad stuff because that's what led you to going passive. Those are actual like interesting stories, and you can look into something. I mean, the framework, which I just kind of speed ran in my story of you, is like the hero's journey framework, which is like the most classic, as you know, storytelling methodology ever. And that becomes the fundamental like building block of your brand, or the cornerstone of your brand, is like this story. Because like I said, something that just occurred to me is I saw you saying all this stuff, but my opinion was, and I read your intake form and I was like, okay, so this guy was a realtor and now he's raising capital. Who is this guy and why is he raising capital and why should I give him my money? Versus when you back that up with, no, I was a successful landlord for a long time and did a whole bunch of stuff. And now I figured out that this is the best path and the best way to get into real estate. Like, I mean, even when I say it, you could probably hear how much more compelling, having that backstory is.
Yeah. Because definitely being a landlord is a lifestyle. And I figured that out pretty quick. Yeah. It is pretty, it gets old fast. And really, and it's like, it's a good point because I gained so many valuable skills during that time. Being able to evaluate a renovation plan and timelines and, vacancies and all that, they're valuable skills that I kind of, to your point, kind of overlook a lot of times. And it's really hard. And that's a other great point is, when you're writing content, it's hard to tell what people are going to resonate with as far as investors, like not necessarily resonate with as far as the story, but resonate with as far as the information they want. So it's almost kind of guesswork at that point. Hey, do they want to know about cap rates or do they want to know about why they should invest passively at all?
Well, and the way that you've figured that out is just volume, and figuring out what's resonating, what's not. But I think that speaking of resonate, I think if you tell or explain any concept or do the education you need to do, if you do that through a personal story, especially if it's like you're able to make it emotional, like, oh, I tried to do this, but then I had a really hard time, and things didn't work out like I thought they would, but then I discovered this new solution and now my life is better. Like, that is, at least in my opinion, the best way to make something resonate with someone, and that people won't even like really realize, or it doesn't feel like they're being lectured at. They're just reading a really engrossing story. And they'll also remember it better because it's a lot easier to remember a story than just a fact. So I mean, what I think you should do, and it's the cornerstone of all our marketing, is you need to build a collection of the stories that you like, your lived experience, but map to the lessons that you're trying to teach people, or the, transformation, specifically like directly owned rentals to passive investing. Build your story archive to tell those stories. And that also helps out way better on a sales call. Because it's not just like in written format. If you get on a sales call with someone and they're like, oh yeah, I'm a business owner, I'm interested in real estate. And I would say, I also want to pause and say that like business owners, I think, are a very good avatar, because pretty much every business owner that makes it occurs to them eventually that they want to buy real estate. I mean, that's how I got into this game. Instead of just saying like, hey, rentals suck and you don't realize it, if you're able to tell a story of, I did the same thing and I bought my rental at this stage, and let me tell you a story. I went through all this, and then I decided this is actually really terrible, and this other thing is better. That is like a way better way to convince someone of something and like have them listen to you. And also it builds your expertise, because you didn't just say, hey, rentals suck, take my word for it. You explained how I did all the work. I paid my dues. Like another Russell Brunson, he's the guy who taught me this. You can go read a book called Expert Secrets, or it's an audiobook. I have it right there on my bookshelf. It's the blue one.
I have it somewhere in my bookshelf as well.
Okay, yeah, read that one. Because what Expert Secrets is about is it's about defining who you are, how it relates to the prospect, and how you communicate to the prospect. And like the entire 360-degree approach to that, which I think is kind of the start here. And do not pass go until you figure this out. Yeah, I would read that. I also wanted to say, in terms of avatars, I told you this before the show, but the audience may not know it. I actually work with other active and retired firefighters who are part of my team at Property Llama Capital. And we actually raise quite a lot of money from firefighters. So I wanted to ask you why that's not also one of your avatars. Or if it is, have you tried it? Has it occurred to you?
Actually, it hasn't necessarily occurred to me. And the reason it's not an avatar of mine is because I know firemen are very resistant to the unknown. So one thing I've learned is just like,
and they're distrustful of people that aren't other firefighters. That I figured out too.
Yeah, and they are definitely kind of monkey see, monkey do type of thing. So it's like, if they're skeptical, and they're definitely in the mode of, save all you can in your retirement fund. And then, and then you retire, with this nest egg type of thing. And it's kind of hard. Like, I found that it's hard to, I have a few guys that are actually rentals and things like that. So they're a little different. But as far as like sitting at the kitchen table, it's a little tougher sell to these guys.
So I think it would be the same advice I gave last time, is tell your own story, because, you would never ask. Another truism that I've heard, might be a Brunson thing, is you would never ask your prospect to do something you wouldn't do yourself.
For sure.
Yeah. And that's why it's important to say, I was in your position. I did this. Talk about your time at the firehouse. Talk about how, and I'm going to use the terminology that I hear a lot, by the way. So speaking the vernacular of the prospect, is that a lot of your brothers at the firehouse, because you guys use that terminology, as I recall, helped you buy your first rental and showed you the way. Because if you notice, that creates like the implied mentee-mentor relationship. And then what that, of course, opens you up to is, I could be your mentor. And stuff like that. Because I would say we've been very successful. I mean, I'll throw out numbers. We've raised, I've got one guy who's a former chief who just broke $1 million with me.
Oh, nice.
And then probably in total, we're probably around 2.5, 3 million from firefighters. I mean, but like you said, I've heard all the same things, that they're very resistant to. Well, number one, I think it's really important, and I got to give firefighters a lot of respect. They have a very dangerous job, and they know that they could be out of a job medically for any reason at any time. And if they are medically unable to work, they will have special financial needs around alternative sources of incomes.
Yeah. And that's a great thing, because I actually retired medically. So
yeah, so did the guy
I retired a little early, unexpectedly, actually. So yeah.
Exactly. And so I think that this just goes again, you got to just rely a lot more and have confidence in who you are as a person and your story and how you got here. And when you tell that story to other, because you could tell that exact same story to a firefighter, where you're like, hey, I got medically retired, but thank God I had these rentals. And thank God my brother's at the firehouse, help me do this. And so that when I was medically retired, I was not destitute, because it's
absolutely. Yeah.
Yeah, because this is what you were telling me is basically the exact same story as Paul, the guy I work with, for the record. Which means that the fact that Eric and Paul have the same story, and these are the only two firefighters in the world that have this story, almost certainly not impossible.
Yeah.
This is extremely common. And he had the same story where he was first a successful landlord and is now much more in the passive stuff. So I would say, and that the way that he targets firefighters is even though he's retired at this point, still very active in the union, because they've got the union hall. I think he's the treasurer.
Okay. Yeah.
Yeah. Yeah. Just give that some thought. I mean, at the very least, everyone in the world thinks firefighters are cool. And if you tell a firefighting story about, these guys who helped you with your first rental and then you were medically retired, but thank goodness you had assets outside of your 401k. There's people besides firefighters who that relates to, but that it does just an exceptional job humanizing you. So,
Yeah.
I mean, I would say talk a lot more about you being a firefighter in your content and where it was in your journey, because there are 900 capital raisers on LinkedIn. And by 900, I mean 9,000,
Yeah.
And the thing is that there are probably very few firefighter capital raisers on LinkedIn, and that there are a lot of people who think firefighters are real cool. And so just own that and make yourself stick out. Okay, I want to move on a little bit. So I'd say, any questions for anything I've said so far?
Not questions, but as far as the hero journey, it's always part of the hero journey is finding a mentor.
Yep.
And, you kind of alluded to that as I got the idea from guys at the kitchen table. Literally, I got that idea.
Yep.
And so I kind of leaned on them to say, hey, when I went and did it, and then when I had to be a landlord, I didn't know what to do. So I leaned on those guys. And it happened again when I got into commercial real estate. I really leaned into communities and things like that. And found mentors that way. Yeah, basically mentors in other communities.
Yeah, I mean, it's a key part of anyone. Well, they do teach real estate in college, for sure they do. But I would say that a lot of the people, at least in our space, who are in real estate, did not major in real estate. We all got into this somehow, And the other nice thing is that, and one of the reasons I like this industry is that owning real estate and being a landlord is very aspirational. I mean, I've met a couple particularly smart people who do not want to become a landlord, but you ask your average person if they'd like to own rentals and they would say yes. Now, that said, the idea of owning rental properties versus the practice of owning rental properties are two very different things. I mean, because I would say our society, and you can correct me if you disagree, but broadly views anyone that has owned rentals as very successful.
Yeah. So, and I feel like another kind of caveat to that is people know owning real estate in general is, a good financial play.
Yeah, they already believe it. You don't have to convince them.
Yeah. But I also think that a lot of people are definitely kind of ingrained in the mindset of, you go to school, get good grades, you go to college, get a good job, you get paid more and save all you can in your retirement fund, and then you retire and move to Florida type of thing.
Mm-hmm.
And I don't know that that is the reality for a lot of people now. I think that having, additional cash flow, additional sources of income I think it has to be done.
Yeah. Well, and I would argue that if you were to say that to almost anyone, they would agree with you that they would like to have passive income.
Mm-hmm, for sure.
All right. So moving on, I want to also ask you about your chosen asset classes that you're raising for, what they are and why you chose them.
Okay. I raise pretty much exclusively for multifamily. And the way I have chosen that is because my skill set translates very well to multifamily. And the way I think of it, and really it's kind of a flip 100 times over in a way, as far as, you have economies of scale and things like that. Vacancies aren't as affected as much, and the underwriting is a lot more complex and all that. But as far as my skill set, I have an idea of, what areas are good based on comps, based on income levels and employment levels and all that. So I have that kind of going for me. And I have also, like I mentioned, is I can look at CapEx, or I look at budgets and timelines and say, hey, is this a solid business plan? Can we get this done in 2 years? How does it affect vacancies largely? And I just feel like with my skill set coming from residential, that asset class is something I can really wrap my head around. The numbers are a little different because, renovating a 2-family costs more per unit than renovating an apartment type of, 100-unit apartment or whatever. But it's definitely something that I can think about and wrap my head around for sure.
Okay, I would throw out an alternative that you should look into on top of your value add deals. I think that especially this goes triple for people that are the pure play capital raiser or the fund of funds manager. I think that you should expand your range with a debt fund product. And I'll tell you why. Number one, your credibility, especially if it's a real estate lending debt fund, of which there are many kinds. I'd say the most typical one, that it would be a hard money fund, the people who do flip loans and stuff like that.
Mm-hmm.
You can confidently speak about that as well, because real estate finance is real estate finance, right? It's about being in a really secure position with a conservative LTV and doing good due diligence on the deal and the operator. And as long as you're conservative with your LTVs and you don't get crazy, it's also an objective truth that within a given deal, the debt position is less risky than the equity position within a given deal, because the equity has to be wiped out before the debt even loses a penny, right?
Yeah.
Yeah. And that I think that goes double in the current environment where people are very skittish about multifamily, I think for very understandable reasons, not to hurt anyone's feelings who's listening to the show. But, on a given, even if the equity deal wipes out 90% of the LP's capital, the debt guys came out whole, probably. You know what I mean? And not just that, the debt guys collected payments the entire time for doing basically nothing after they underwrote the original loan, And
Yeah.
Thirdly, when you were talking about like the goal of passive income, debt funds, at least all the ones I've seen, produce substantially higher consistent income than an equity deal. An equity deal is really more about kind of a highly leveraged value add, like growth play, and you get almost all the money in 5 years. That does not actually, in my opinion, align very well with the stated goal of passive income, because they're usually like zero cash flow for 2 years and then very low double digit for another 2 years, and then it sells and hopefully you make a big multiple. But that unless you had a syndication ladder, or you were making tons of syndications and you had them properly planned so that you have a few paying off every year, it isn't actually that congruent with a stated goal of passive income. If your goal is capital growth, now I'm not going to like completely trash multifamily here, because what is multifamily for sure? Way more tax efficient, because of like depreciation and all these other things. Number two, it typically can yield, I would say in general, though not always, can be higher IRRs. But if the pure goal is like, I need income, then you should probably be in a debt fund. And I will tell you how that translates to you as a capital raiser. Here's another benefit of a debt fund. A debt fund is also, generally speaking, usually always open. So you don't have to like rush super hard to say like, oh, I got 90 days to come up with my 5K, and then it's over. And then I have to start marketing the next deal. It's always open. Like very typically these things raise for years. Eventually they'll reach a certain size and have to close. Like you can raise for the same product for years. And not just that, you can be, instead of just forward looking with a pro forma and saying, oh, if all goes well, we should make money. You can actually point to past performance in a debt fund where you can say, hey, look, this thing has been going on for 3 years and they've been doing like 11% a year for the past 3 years. That's such a less risky proposition. Well, okay, that's not financial advice clearly for anyone listening, but that you could make the case that an investor would view that as like a lot less risky to invest in something that's already working. And also they can say not now to you. And then every month you can tell them like, hey, dividend check just hit. This was our performance last month. We're still open. And
yeah. So one thing that you mentioned is also with multifamily, I definitely still believe it's a good product or whatever, but I think that there needs to be a delineation is like people looking for, basically higher cash flow and then, it kind of comes down to investor goals as well.
No, totally, 100%.
Yeah, for sure. So, having a debt fund, yields consistent higher cash flows. So people, if that's what investors want and that's their goal, that fits very well as a complement to multifamily as well, where, I think there's kind of the delineation would be is like, are you looking for cash flow or are you looking to build equity?
Or do you need
Because
tax benefits?
exactly, yeah.
Yeah. I'm going to blow your mind. It's even better than that. All the investors at least all the ones I talk to, they have completely separate pools of capital for each strategy. So having two products instead of one, especially like debt plus equity, I bet you that 80% of the people you can convert to an equity product will also put a position in cash because they view it as lower risk and their income bucket. So they've got like a larger allocation to it versus I think the equity investments are usually their risk pool, which is by definition small, like as it should be. But that like your income or bond part of your portfolio where I just need stable income and I'm going to park it, I think it's even more money from the same customer. So you're basically able to raise more capital from the same customer if you have both of these products. And that I would say my personal experience is that so between my partner Chris and I, and between Property Llama Capital, which we have now, and the fund where we both started, we've raised about $75 million. We've done about a dozen equity deals. We've done 2 debt deals in total. About 66% of all the money we've ever raised is those 2 debt deals.
Yeah, I mean, those are incredible numbers. I love it. And
yeah,
I love the advice too, because honestly, that hasn't been on my radar because basically not being lazy, but not necessarily feeling comfortable learning a new asset class.
It's not that
So,
new though.
yeah.
If you were to look into a hard money fund and you're a smart guy and you've been doing real estate for like 9 years now, or is it 11 years? 11 years now, you will understand the economics and a presentation of a hard money fund like that.
Yeah.
Because you've done
Yeah.
rehab yourself, and that they're like, hey, we underwrite a flipper. Here's his purchase price. Here's his ARV. These are our underwriting parameters. We prefer to work with experienced flippers. Basically, the whole project has to go to hell in a handbag for us to even lose $1, and we clip very good monthly income and you do nothing.
Yeah.
Trust me, as a real estate guy, it will be very easy for you to learn hard money loans.
Yeah. So I know what I'm getting started on this afternoon is learning hard money loans for sure.
Yeah. Yeah. And I think also being a capital raiser means, and I've said this on the show a couple times, but maybe not lately, is that, so you've got deal guys and capital guys, right? Deal guys' lives revolve around deal and whatever strategy they're good at. And then they only need investors because they just require investors to do more deals.
Mhm.
And so, but that investors are much lower on their list. Their business is focused on the deals. Us as capital raisers, and I think this is a very good thing for everyone involved, we are focused on our investors and what are they trying to accomplish and what are their needs. And also we have the flexibility to assemble a suite of products, and not just like, because if you go talk to a development guy and you're like, what are your financial goals? And no matter what you say, he's going to be like, I think development is the right thing for you. Like that's what he's going to say. And he probably believes it too, like no disrespect at all, but he's going to be like, you need grade A development in your portfolio. Versus us, you can talk to a guy and say, he's like, well, especially like a firefighter. Oh, you want to allocate some passive income? If you throw $100K into this debt fund, I can get you $1,000 a month. Like pretty easy. There aren't a lot of other products that can also get you $1,000 a month day one, compared to value add. So I just think every capital raiser, and I knew this before we even got on the phone, like needs to have a debt fund. This was actually going to be, and the reason I put it last is like my actual like main piece of advice for you is to have these 2 products. And also in this current environment, at least me, sample size of 1, the debt fund is selling just dramatically better right now because given the macro climate and the just general skepticism about multifamily, you can just make such a solid case for a better fit for goals, which is income. Also, because the reason everybody invests in real estate, they don't invest in real estate. At least I'm talking about someone who has never owned rentals. That person does not have sophisticated thoughts about a growth play and all these tax advantages. No, someone who has never owned rentals and is in this space where they're learning it, they're just like income. Like they have been sold by society, I think largely incorrectly, that rentals are a great cash flow vehicle. When in reality, they're not. They're appreciation vehicles, but that like a really successful single family home yields like a couple $100 a month, even if it has like high six figures or sorry, like low six figures or high five figures of equity in it. Like do the math on that. That's like a 2% cash on cash. That's lower than a bank account these days. And that whole transformation thing works well for them because it's very like, hey, you want this and you believe in rentals? Well, I'm about to rock your mind that actually debt funds are better for you. And here's like 9 reasons.
Yeah.
Immediately, like that's a powerful talk track.
And it's all about matching investors with their goals. And,
Yeah.
That's really our job,
And I also think that at least for now, and this will change eventually, there's a lot less competition for debt funds than there is for value add. There is just endless amounts of guys pushing value add on LinkedIn, way less pushing.
Yeah.
So yeah, I would say I think that. So to review, number 1, tell a lot more of your story all the time, and in fact, I'm not going to say like most of your posts, but start experimenting with, instead of just like telling someone and trying to educate them pure facts, figure out how to pull a personal story and tell it like that. Build your story archive. Number 2, I would say take another crack at the firefighters things, especially using the same approach of just telling your own story and telling your own story and telling your own story and being relatable. And then I think number 3, you need to add a debt fund. So I would ask if you have any concluding questions or remarks. How are you feeling about all this?
As far as how I'm feeling, I love it. I love the advice for sure. Telling it for one, telling a personal story is easier than coming up with content that you hope people will like.
Yes.
And like, I'm so excited to get started learning debt funds right now, like really excited. So yeah, I appreciate it, man.
Yeah. Dude, awesome. So, Best Ever listeners, I just want to remind everybody that Best Ever Conference is coming up in February. Get your tickets now at bestevercre.com. I will see everyone there. I'll be there. Thank you for tuning in.